Good afternoon and welcome to the overview of the Bite-Sized Tax Highlights webinar. My name is Dominic Bourquin, and today we've talked about three broad subjects. Firstly, we've talked about child benefit changes. The important points here are to remember that if you earn over £50,000, you may not be entitled to child benefit anymore, and if you are not entitled to child benefit and continue to receive it, you will have to submit a tax return every year to ensure that the child benefit is collected back from you. So that's the second point to note, is that if you take the child benefit that you're not entitled to, it will be collected back from you. The other thing is if you don't submit your tax return to allow that collection to happen, you will be subject to penalties. Tax returns can be submitted by the 31st of January 2014, and you use a form SA1 to register to submit that tax return. The tax return registration should have been completed by the 6th of October, so that's 9 days ago. So I would urge you, if you have received child benefit you're not entitled to, that has to be paid back, to register to submit a tax return now. If, on the other hand, you don't want to continue receiving child benefit that you have to repay, you can elect out of the regime completely, and that can also be found on the Revenue's website. The second area we tackled was inheritance tax, and the fact that certain debts of the deceased may now not reduce the estate value. The Revenue have changed the rules here, and there are two particular areas that are caught by this. The first one is that if you have a debt of the deceased that is not paid off out of the estate, then that will not reduce the value of the estate for inheritance tax purposes. And secondly, if the deceased has borrowed money and secured it against personal assets to buy tax-exempt assets, so things like farmland or perhaps shares in an unquoted trading company, then those debts will now no longer reduce the value of the estate. Therefore, the inheritance tax bill will be higher. And lastly, we talked about late claims. Late claims for overpaid tax will only be made in certain circumstances, for example, where there's been an error by the Revenue, or where perhaps you've been so ill that you haven't been able to make the claim yourself in time, or you haven't been able to seek assistance from an advisor because you have been so unwell. However, the important point here is that, again, there is a further change, which means the Revenue may now consider, when they are assessing whether to allow your late claim for a tax repayment, whether you have entered into a tax avoidance scheme and whether the late claim is part of that tax avoidance scheme. If it is, I think we can pretty safely say you will not be allowed to make the late claim, and that is the point. The next tax webinar will be on the 13th of November 2013. The full Bite-Sized Tax Highlights webinar from today is available on our website, and if you'd like to download that, then our web address is www.monaghan's.co.uk. Thank you very much for listening.